you how we can arrive at equilibrium. Silence, please. And then we will try to understand whether this model is practical, is testable. So we will look at some papers using this model before, and the test is model before. And then what we will do, we will finish the case study. Okay, so first of all, as many of you should notice, is the capital asset price model introduces an equilibrium that is underlying the modern finance theory. The model was developed in the early 60s by Reno, Sharper, Linder, and Mossin. And this is basically a theory that puts in relation, they tell you how the asset should be priced, and replicate the assets are pricing, of course, in relationship of the risk profile. There are, what we will see, basically, it's to arrive to define content, we use the principle of diversification. There are several assumptions that we need to take into account. It's based on the assumption that investor cannot set the price, so they are price taken, the prices are given, they cannot modify the price that are there, are in the market. The investor invests the money just for a single period. This is related to the idea of, then what we have, they can, the third copy is related to the possibility to have access to unlimited risk-free rate to borrow and lending opportunities. Some condition of the market, investors do not pay taxes, there are no transaction costs on trading activities. Then, when they have to define, so investors are rational, and how to behave, they try to define the portfolio applying the mean and variance rules we have seen before. When they think and when they have to select the portfolio, they do in the scope to find the optimum portfolio based on the logic of mean and variance. What they do, all investors analyzing the security in the same way, and so they have homogeneous expectation, and this means that they invest the money in the same risky portfolio. So what it changes among the investors is the quantity they invest in this market portfolio. So the idea is that all the so there is it is what there is here. All investors belong to the same portfolio of risky asset. This is portfolio of risky asset is market portfolio. Same homogeneous expectation. And the market portfolio includes all the securities and proportion of each stock in the market portfolio equals to the market value of each stock, divided by the total market value of all the stocks. So if they have the same expectation and people, so they invest the money in the same risky portfolio, what it changes, as I said, is just the quantity that they invest in the risky portfolio. Since they are rational and they select the portfolio based on the mean variance rules, what they hold, the investor, so they put the money in a market portfolio that is also the optimum portfolio. So we go back basically with these slides to what we have seen the last time. Remember the capital allocation line? We were able to identify, you remember, on the tangency point between the efficient frontier and the capital allocation line. Now we have the capital market line because my portfolio is a market portfolio, and all investors, as I said, all M, and keep in mind that M is the optimal risky portfolio. So we have something like that. So the same stuff that we see. And this is my market portfolio. So people invest the money in these guys, that is the optimum portfolio. As I said, what it changed for the investor is just the money that they invest in M, and this is given, as we know, by the risk aversion of each investor. So if they are more risk averse, they will be on this line more close to the risk-free asset. If they are less risk averse, then they will be more close to M. Okay, so we have a picture like that. Optimal risky portfolio, risk, based on the risk aversion, they can be in some points here on the line. Of course, we know that in the case of the capital market line, the capital allocation, this is, if you go back to one of the first, I think in the first class, I explained what is an active and passive strategies. Here, since the investor put the money in the market portfolio, they are following, and the market portfolio should be highly diversified. They follow a passive strategies. They do not. So the assumption is that all the basically securities are fairly priced. There are no possibility to gain very much. So if I want to know the risk premium of an individual security, the risk premium of the individual securities is just a simple function of the individual securities contribution to the risk of the market portfolio. So when I speak about you know, what we should be familiar with the definition of the stock, I just think about what is the risk. So when I think about the risk associated to a single security I just measure the risk premium in relationship to the contribution that the stock I is making to the market portfolio. And specifically, the risk premium of individual security is just function of its covariance with the market. So now we try to understand how this capital allocation, how the capital asset pricing model can allow me to define an equilibrium between risk and price for a security I. So we will try to understand how the formulas come up. Now that we know what are the assumptions, and now that we know what the market portfolio is. So first of all, as we said, what we can do. So first of all, we assume that a risk-free asset exists and the investor can buy or sell it. These are the assumptions of the model. If they said they can use the proceeds to invest in other securities, we'll see how it's working. So suppose that we have this market portfolio M, and the market portfolio M consists only of two assets, GM and IBM. Okay? So if I want to know the contribution of each asset to the risk of the market portfolio, from now M means market portfolio, I can write down, I know very well what is the variance of my market portfolio. I can just solve this equation once for GM. So here I can identify the contribution of GM to the market portfolio. Simple. Here I just take the quantity that I invested in GM. So here is GM, so this multiplication is here. This quantity concerns IBM, so if I want to know the contribution of GM to the variance, the risk of my portfolio, this quantity is not here. Here, I just take the quantity that is relative to the weight of GM. Then I can also do the same things for the other stock. So basically, I just identify the components of risk that are just associated in the first case to GM and IBM. So this is the contribution of this stock to the variance of my portfolio. So in this case, here, basically, I can work out, suppose that I have many assets, so I can, once that I have this formula, I can generalize the formula also for and stock in my market portfolio. And at the end, it can be shown that the contribution of GM, so specific stock to the variance of this simple algebra, minus of my portfolio is just equal to the weight multiply the covariance of my stock GM compared to the my market portfolio. And correct here, I can just apply these rules, so I can just let's say take out from the parentheses my weight. So if the covariance, if this guy here is negative, this means that general GM makes a negative contribution to the portfolio risk. So what does it mean, a negative contribution to the portfolio risk? This means that it's going to reduce, as we already saw before, the overall risk of my portfolio M, simply because I have a negative. And if it's positive, this means that if I include that stock in my portfolio, I will amplify the volatility of my portfolio. So now, let's say I was able to work out the contribution of each stock, let's say in this example, stock GM to the risk of the market portfolio M. The next step that I need to identify is the risk premium. So how I can arrive to define the risk premium of, and if you go here, you said this is going to be functional on this covariance with the market. So to arrive to define the risk premium, what I need to do, I just work out simple steps, simple algebra. So what I do, I assume that I invest 100% of the money in the portfolio M. This means that the weight of my portfolio M is equal to 1, because I put all the money there, clear? So what I can do here, I want to know if I increase the position in M, how basically I'm going to, what is going to happen if I just invest a little bit more money in M. So, and since we said by assumption, if you remember the assumption of the model I mentioned before, investor can borrow and lend the money at the risk-free rate. So if all my money are in the portfolio M, if I want to put more money in M, I need to borrow more money somehow. And based on the assumption of the model, I can borrow this money at a simple risk-free rate. So what I do, I can have a new portfolio N that is just equal where M plus a additional quantity, tiny quantity that I invest in M, minus, the risk-free rate that I use to borrow, for, I took a short position in risk-free rate to collect additional money to have more, to invest more money than my equity on time. So if I want to know the rate of return of the new portfolio N, what I just need to do, I just calculate the return of M plus, the return of my portfolio N is just equal to RM, that is the return of the market portfolio, plus the additional return that I can have investing a tiny component in M, minus the money that I borrow. Of course, the return of my portfolio is going to be equal to the quantity that I invested minus the stuff that I borrow. So I can group this quantity, I can sort out this quantity here, and I can rewrite these guys in this way. Then I I can also, I can also calculate, as I was able to calculate the rate of return of my new portfolio, I can also calculate the variance of my new portfolio. And the variance is going to be equal to, of course, the variance of the risk-free rate is zero, because by assumption the risk-free rate doesn't have any risk. So the variance of my n portfolio is just equal to 1 plus d, so the quantity 1 plus the additional quantity that I invest in m, plus the variance of my portfolio m. So what I can do, since I know the rate of return, I can also calculate the expected return. I can calculate the expected return of my portfolio n. That is just, and I can also see how much is the, let's say, increase of expected return of my portfolio n compared to m. And this is just given, so if you just do the expected return of this quantity here. So if you do the expected, you can see that the expected return of n is just equal to the expected return of m plus then d expected return of m. So just looking at these guys here, minus so I can just group then these guys goes here on the other side of my equation, so I can see the incremental expected return from investing in n minus m. So if I bring these guys here, then I just group for, and then I just start here. Okay. Then I can also do the same stuff for the variance of my new portfolio minus, so I can see the incremental risk. So what I'm doing now, I'm trying to understand what is the incremental risk from investing just something more in, just a tiny quantity in M. And these guys here is just, you just take again, you take this part here, you just put these guys on the other side, and then you can say that so these guys minus these guys is just this quantity. Then I can say that since delta is a very small number, I can say that if I take this number here is almost zero, so I can just assume that this quantity here, this cross product is zero. So at the end I can see that the increase, the incremental risk of this investment is just equal to this quantity here. So then if I do the ratio, what I get here is basically, what is this? So I can also do the ratio between my risk premium and the incremental risk from investing in M. And what is this guy here? What is, how do you call that ratio there? Huh?
Marginal price of risk.
Yeah, but how we call it in the past? What is this? It looks familiar to you. The solution is always one, this type of, what is this? The Sharpe ratio, exactly. And do you remember what is the Sharpe ratio in our capital allocation line? Is the slope of the line. So keep in mind this, because now I show you what is the implication graphically of this slope. So now, let's say we invested, as I said, we borrow the money to put more quantity on M. What we do now, we try to understand investing, now I borrow the money to invest more quantity in M. What is going to happen if I borrow the money, if I just invest not anymore on M, but just in a single stock? So what's happening here, the exercise is the same. I invest 100% in M, then I borrow an increment delta and use this money to buy the stock GM. So it's not anymore M, it's just a single stock. So this means that the performance of my new portfolio is going to be equal to the return of the market portfolio plus, in this case, the tiny quantity that I'm investing in a risky asset GM minus the money that I borrow. So again, I can also understand the incremental risk premium, and then incremental risk. So what I want to calculate now is the incremental risk premium, incremental risk of the new portfolio N, where I borrow the money to invest in a single risky asset in addition to the market portfolio. So what I do here, I can calculate the, let's say, this incremental risk premium as the difference of the expected return of this quantity minus the expected return of the risk of the portfolio M, because I want to understand the incremental risk of new portfolio with respect to M. And if you just work out in simple algebra, you will get that this quantity is equal to delta multiplied the expected return of GM, the risky asset, minus the risky rate. I can also calculate the incremental risk of the new portfolio N asterisk, and this is again given by the difference of the variance of the risky portfolio N minus the market portfolio. And again, if I sort out the simple algebra, I will remember that of course the risk of the risky asset is equal to 0. This is a very small quantity. We said that delta is a very tiny quantity, so if I multiply a very small quantity for itself, I'm going to get a number very close to 0, so we can say that this quantity is equal to 0. And then at the end, I can calculate again the marginal value of risk of portfolio N, that is, so again, another Sharpe ratio. So, since we must have in equilibrium that this is how in equilibrium, so based on the capital asset pricing model, these guys should be equal. So this means graphically that if your capital asset pricing model work, if this is remember your capital market line where M is your portfolio, if I invest a quantity in the risky asset, my frontier is going to be something like that. So I will have a frontier something like that. This means that the slope of my as you can see, both the cube are tangency to the point M. So this means that in equilibrium, the slope of my of the frontier, where here I can have a combination of my market portfolio and the risky asset, must be tangent to M. So this means that in equilibrium, the slope of I just have one slope, and the tangency point pass through M. This is why the Sharpe ratio, that is the inclination of the line for the market portfolio and for an asset, risky asset I, must be the same. This is what capital asset pricing model tells you. So in equilibrium, I should get my risky asset should be on these guys here, that is tangency to the point where the pass through M, that is the market portfolio that is on the line that tanges to the efficient frontier. Here I have all my risky assets. Remember that here is a combination of the optimum portfolio. Here I have all my risky assets. Okay? This is the combination. Here you can also find more or less the logic is the same. Then you can find also as county stages some sort of demonstration that is the same, is more or less the same of what we have done. So I suggest to stay with the slides, but here is how you arrive to define the same curve. So this is the intuition of the capital asset pricing model. So what we have here, I can rearrange these two equations in a such way that I can write the risk premium of my stock I, my risky stock, so this is my risk premium, as a function of these guys here, that is my beta, and then is the this is the market premium, so it's the expected return of my market portfolio minus the risk rate. Remember that what we saw before, that if you go back here, we saw that the contribution of GM to the risk profile of my portfolio is proportional to the covariance of, so comovement of my risky asset I with the market and the quantity that I invest in the stock. So this is the contribution of the stock to the variance. This is instead how I can arrive to define my equilibrium. So what you notice here, so the equilibrium between beta and my return. What you should notice here, that here we are using expected, in this relationship we are not using the actual return as in the case of the index model. What we have here, we have the relationship that works out the equilibrium between the expected return and the beta. Beta is how much GM contribute to the risk of the market portfolio M, so is the covariance. And then, okay, this is the contribution of the risk of GM, of the security I to the market portfolio, multiply here for the risk premium that I have for my market portfolio. So what you notice here, that there is any idiosyncratic risk, something that was there before in our index model, there is no reward. The only reward that you get from this model is reward for systematic risk. Beta, remember, no idiosyncratic risk, no firm specific risk of conduct. Okay? Again, what this beta means, beta is the measure again the contribution again to the variance of market portfolio as a fraction of the total variance of the market portfolio here. And again, beta minus 1 means that the individual asset is less risky than the market portfolio. Equal 1, same risk of the market portfolio. Higher than 1, individual asset riskier than the market portfolio. Of course, it's also old for the market portfolio. In this case, the beta of the market portfolio gains itself. The covariance of the market against the market is just the variance of the market.